In this video, I'll discuss 10 of the most popular Vanguard Exchange Traded Funds, but don't worry if you don't use a Vanguard platform to buy and sell shares. You can still purchase all of these ETFs on most investing platforms. I'll look at the aims of the ETF, what sectors and companies they track, and their overall performance over the last 5 years. While researching this video, I discovered something that will actually change the way I invest. There is one ETF here which I was so impressed by, I'm going to add it to my portfolio right away. I'll reveal which ETF that is at the end of the video. If you are thinking of starting your own investing journey and really have no idea what to invest in, then a good place to start is an index tracking ETF. Buying individual shares can be very risky, and with over 55,000 listed companies, picking a winning share is like searching for a needle in a giant haystack. So why not forget all that and just buy the whole haystack instead? Well, with a global ETF such as VWRL, you can basically do just that. The aim of this ETF is to track the FTSE All-World Index. You would own over 3,600 global companies from both developed and emerging markets worldwide. This ETF pays a dividend of 1.6% per year, and the ongoing charge is 0.22%. There is also an auto-reinvesting version called VWRP, which instead of paying you a dividend as cash, will instead auto-reinvest it to buy more shares. All the ETFs I'm showing in this video are the dividend-paying versions, but there is an accumulation version available in each case if you visit the Vanguard website. When you search for an ETF and see the abbreviation ACC, this means accumulation, and you will automatically buy more units. DIS, or sometimes DIST, means distribution, and you receive the dividends as cash, which you can reinvest yourself into the same ETF or something else. The accumulation versions are slightly more cost-effective in the long run, but it's a matter of personal choice which version you go for. A common misconception is that many investors think there is no dividend tax to be paid on the accumulation version, as you don't actually see the dividend. However, you still may be liable for dividend tax whatever version of the ETFs you buy, unless of course your investments are inside a stocks and shares ISA or SIP, where there will be no capital gains or dividend tax to pay. This screen shows where the companies are based in the All-World ETF. Nearly 60% is from the USA, with the UK making up less than 3.5%. Here are the sectors you would have exposure to, with technology making up the largest slice of the pie at almost 25%. And here are the largest companies you would own with this ETF. No surprise that most of the largest ones are from the US. So what about the performance? Well, over the last 5 years, the total return, that's the dividends plus capital growth, is 61.9%. In simple terms, £1,000 invested in this ETF 5 years ago would now be worth £1,610. Now, do be aware that this is over the last 5 years, and past performance is no guarantee of future returns. And nothing in this video should be considered financial advice. Another ETF you might consider is VHYL, and the aim of this one is to give you exposure to almost 2,000 global large and mid-sized companies which pay higher dividends. The yield is 3.1% a year, and the ongoing charge is 0.29%. Again, the US makes up the majority of holdings at 42.3%. The financial sector makes up the largest proportion at 25%. And here are the largest companies you would own. So how has this one performed over the last 5 years when capital growth and dividends are taken into account? The return is just under 40%, which is more than 20% less than VWRL we looked at earlier. So although the dividends are higher, overall VHYL has not been as good. If you want a really cost-effective platform to start your own investing journey, then Trading 212 will give you a free share worth up to £100. All you have to do is click on the link in the video description and open an account today. The next Vanguard ETF selects companies based on environmental, social and governance factors. ESG factors are non-financial and can include such things as their carbon footprint, water usage and impact on biodiversity. The social aspect considers how the company treats its employees and its stance on human rights, diversity and inclusion. And the governance criteria considers such things as leadership, executive pay, internal controls, and shareholder rights. So if you are looking for a diversified portfolio of ethically responsible companies, the ESG Global All Cap ETF might be worth considering. The ticker code is V3AM and it includes nearly 6,000 large, mid and small companies from around the world, which have a high ESG rating. It pays a dividend of 1.3% and the ongoing charge is 0.24%. US companies make up 60% of this ETF. Technology stocks make up 29%, with financials the second highest at 15.6%. And here are the 10 largest companies you would have exposure to. Although there are nearly 6,000 companies in total, it's weighted by capitalization, so just these 10 make up 22.6% of the entire ETF. The 5-year performance for this ETF is around 37.6%, but I've had to estimate it, as this particular ETF has only been in existence for the last 3 years or so. If you want to buy stocks in developed countries worldwide, then VEVE might be worth considering. It tracks over 2,000 of the largest stocks in developed markets across the globe. It has a dividend yield of 1.6% and the ongoing charges are 0.12%. Here are the countries you would have exposure to, with the US at almost 65% and Japan next at 6.6%. Technology would be the biggest sector at 25%, and here is a list of the 10 largest companies you would own. So what about the performance of this ETF? Well, over the last 5 years, the total return, which includes capital growth and dividends, is 69.4%. The next ETF tracks stocks from emerging markets worldwide and has the ticker code VFEM. It contains 2,144 companies, has a dividend of 2.5% and the ongoing charge is 0.22% a year. China, India and Taiwan are the largest countries you would have exposure to. Financials, technology and consumer discretionary make up the 3 largest sectors. And here are the largest companies, and the ones shown here make up 22% of the entire ETF. The 5-year total return for VFEM is 13%. Now, if you think Japanese companies will do well in the future, then there is a Vanguard ETF called VJPN, which tracks over 500 Japanese large and mid-cap stocks. There is a dividend of 1.8% and the ongoing charge is 0.15%. Industrials are the largest sector you would have exposure to, and they make up 23% of this ETF. Here are the largest companies, with Toyota at the top, but also including the likes of Mitsubishi, Sony and Hitachi. The total return over the last 5 years is 34.6%. If you want to invest in Europe, then you might consider VEUR, which consists of over 500 large and mid-cap stocks from developed countries in Europe. The dividend yield is 3.1% and the ongoing charges are 0.1%. The UK, France, Switzerland and Germany are the largest constituents in this ETF. Financials and industrials make up the largest sectors, and here are the largest companies you would have exposure to. The companies shown here make up over 20% of the entire ETF. The 5-year performance of this ETF is 41.4%. If you think it's time for UK stocks to do well, then you might consider one which tracks the largest UK companies. This one has the ticker code VUKE and has a dividend yield of 3.8% and an ongoing charge of 0.09%. Financials, consumer staples and industrials make up the largest sectors, and here are the companies you would have most exposure to. The 10 shown here make up almost half of the entire portfolio. It's worth pointing out that although this ETF contains only UK companies, these companies are the 100 largest in the UK and are global giants, earning an average of 80% of their revenue not from the UK but from around the world. Performance over the last 5 years is 38.3%. If you want to invest in smaller UK companies, then you might consider a FTSE 250 ETF. This one has the ticker code VMID and tracks around 250 of the largest mid-cap companies. Now remember that the FTSE 100 giants I mentioned earlier only generate 20% of their revenue from the UK, while the FTSE 250 companies on average generate around 40% of their revenue domestically. The return of this ETF therefore is more closely tied to how well the UK economy is doing compared to the FTSE 100. Financials make up by far the largest sector in this ETF, followed by industrials, consumer discretionary and real estate. The 10 holdings shown here make up around 10% of the ETF's entire value. The total return over the last 5 years is 22%. If you want to invest in US stocks, and a very popular ETF is VUSA, which tracks the S&P 500, which is the largest 500 US companies by capitalization. Dividend yield is 1.1% and the charges are very small at just 0.07%. The largest sector is technology and makes up 33% of this ETF. And here are the top 10 holdings you would own. These 10 represent almost 34% of the entire ETF. Over the last 5 years, the return on this ETF is a very impressive 92%. And here is a summary table of all the Vanguard ETFs mentioned, listed in order of 5-year return. As you can see, the S&P 500, ticker code VUSA, has returned 92% over the last 5 years. It's performed significantly better than the All-World ETF, and the costs are cheaper. You might question the logic of owning VWRL when around 60% of it is in the US anyway. The reverse argument of this is that when global crashes have occurred in the past, the US market tends to fall harder and for longer, and therefore owning VWRL instead might mitigate some of this risk. If we compare VWRL with the high dividend version VHYL, it's interesting to note that although VWRL pays a lower dividend, it has performed more than 20% better over the last 5 years. Now remember, historical performance is not a guarantee of future performance, but the results are still quite interesting. The other intriguing conclusion I've learned from this research is comparing VWRL with the Developed World ETF VEVE. The Developed World ETF has a lower cost and has performed better. This is because VWRL contains some companies from the emerging markets, and you can see here how relatively poorly that particular ETF has performed. So based on these findings, I've decided to start buying VEVE instead of VWRL. If you still like the idea of buying VWRL because you want at least some exposure to the emerging markets, then there is actually a way of achieving a similar goal at a cheaper price. Instead of buying VWRL and paying 0.22%, you could instead buy 90% of the Developed World ETF VEVE and 10% of the Emerging Markets ETF VFEM, which would give you a similar makeup to VWRL, but you would only be paying costs of 0.13%. Which ETFs do you hold and what are you thinking of buying next? Let me know your thoughts in the comments. Please like and subscribe if you found this video useful. See you next time and happy investing.